So hello everybody, and welcome to this session of Business Bite-Sized. So this week I thought we could talk about debt funding and finance. So we know that the recovery loan scheme is now in place, and that's essentially a replacement for both the Corona virus loan scheme, the B-bills scheme, and the C-bills schemes that were in place to help businesses through the pandemic. So recovery loan scheme is a little bit more in line with the C-bill scheme and more in line with traditional lending. So whereas B-bills was basically a tick box exercise to get some money into the economy fairly quickly, and I think worked very well, the recovery loan scheme is more traditional. So you are going to be subject to credit checks, and the banks will want to know that the loans, the finance that you're taking on, the debt that you're taking on is going to be affordable, particularly in terms of repayment. So as we know, with Business Bite-Size, we like to keep things simple here. So when you're thinking about debt finance, I think there's three things that you need to think of, the three S's, if you like. They are security, serviceability, and skin in the game. So security is quite an interesting one. Lots of people have often got some quite strong security to back a loan, and for that reason they can't really understand why the banks won't lend. And it's usually not a security issue, then it's probably a serviceability issue. So what's security about? I think it is, again, it's very simple. It's just that the lender needs something to hang their debt on, if you like. So they need something that's going to provide security if you're not able to afford to repay, so they can get their money back. So in an asset finance situation, that's very clear. It's the asset that they're funding, and the loan will be secured on that. So if things don't go according to plan, they'll recover the asset and hopefully dispose of it and get sufficient proceeds to pay off the money that you owe. Invoice discounting, again, the money advanced is secured on the customer invoices that you issue, and that's become a very popular way of funding working capital, replacing overdrafts, really preferred by the banks, and has more flexibility. Of course, as you issue more invoices, the balances owed from customers go up, and you're able to draw more money against it. So quite a flexible approach. Another one might be if there's insufficient assets within the business, you might secure the loan on your own personal property, the form of a personal guarantee. That might be another one. And in some cases, there's sufficient assets on the balance sheet. It might be a mix of assets. It might be outstanding debtors. It might be stock. It might be fixed assets. And the banks funders may, in some cases, be quite happy just to secure the loan on the balance sheet assets of the company. So security needs to be in place, but it's certainly not the be-all and end-all. So number two is serviceability. Can you afford to repay the loan? And really, the lenders won't want to enforce their security. They'll want you to repay the money. Enforcing security is really not a great solution for them. So serviceability, the way this is done really is to use an EBITDA number. So EBITDA, earnings before interest, tax, depreciation, and amortization. So basically, take the net profit figure in your accounts, add back any interest that you've paid, any tax that's taken out of that profit figure, depreciation and amortization. And that figure then, the EBITDA number, will give you an approximation to the cash that the business generates. And if you multiply that number by 3, you're getting an indication of what the banks or the lenders feel is an appropriate amount of borrowing, 3 times EBITDA. So, as I said, serviceability is key. It's often where an application fails. There's plenty of security possibly, but if the loan isn't serviceable in the minds of the lender, then it won't go ahead. And this is something that causes some confusion and some disappointment, I think, with clients. They have lots of security, but the application will fail because of serviceability. Then the final S is skin in the game. So the banks will be looking for you to have some of your own money invested in the business as well. So their simple approach is that if they're funding 100% of the purchase of an asset or some other thing, some other need for funding, they're putting up 100% of the money. They tend to view that as an equity type investment, not a debt type investment. So debt is not about funding everything to the full amount. Really, it's about putting some money in alongside the money that you're investing in the business. So skin in the game. What skin have you got in the game? Most lenders will ask for potentially at least an unsecured personal guarantee. And again, the reason for that is not so much recoverability, it's not so much about security, it's about actually having some commitment from you, because you're running the business, you're involved in the business, and if things don't go according to plan and you walk away, they know very little about the business and the customers, etc. So they really need some commitment from you, that you're going to be around to collect debt in, etc., money owed from customers. You're going to be around to collect that in order to repay their debt. So that's just a really brief overview of a debt approach, the things you need to be thinking about. So 3 S's: security, serviceability, and skin in the game. I'll talk in a separate session about investability. So this is equity investment. Obviously, those things are important too, but there are some slightly different factors that we take into account when we're looking at investment. But I'll cover that in a different session. So recovery loans are available now. I think, again, like CBILS and BBILS, they will be quite useful for the right people. We don't just need to go to high street banks. The number of lenders will increase over the next few weeks and months. And there certainly are alternative providers out there to the traditional high street banks. So if you have a funding need, if you can see working capital issues as you try to grow your business, then give us a call and we'll have a look, put some numbers together and see whether you look like you're fundable or not. Thank you.